The collapse begins. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, this major economy is about to crash, and I'm going to show you why it means we're next. Let's over to Bloomberg, where we picked today's story up with the headline, China growth disappoints as Beijing hits at a muted stimulus, and that's why we're in Beijing. You see it in the background, because when we start to talk about stimulus, why would Beijing, who we know in the past have big users of stimulus, all of a sudden kind of back off from that and say, well, maybe we'll do a little bit here? Is it because their economy is not slowing very quickly? Or I think the real issue here is they believe that the rest of the world is going to have a soft landing. And if you overdo your stimulus at a point where the rest of the world is about to turn and move higher, which again, I know we don't quite think that, but that's the general view right now, that all of a sudden China can get a huge surge of inflation, which is something that they don't want. That one of the challenges here, if you look at the second largest economy in the world, the biggest exporter in the world, if their demand is going down, not only externally, but internally, well, it means demand in the U.S. is coming down in a big way too. Gross domestic product grew at a slower than expected pace at 6.3% in the second quarter compared with a year earlier when dozens of Chinese cities were in lockdown, but just less than 1% from the first quarter. Deflation is a major risk now, the data showed, with an economy-wide prices declining for the first time since 2020, while youth unemployment climbed to above 21%. So here we're finally seeing this word deflation pop up again. And in a debt-based economy, it doesn't matter whether you're socialist economy or any other form of economy, deflation is bad news, because not just from the consumer standpoint, where a consumer looks at prices and says, you know, I want to go buy something, but I think the price is going to come down in the month or maybe a year or a couple of years, so I'll wait and purchase it later and defer that, and instead perhaps pay down my debt. Or you look at it from a business standpoint, a business who has just raised their prices, given their employees raises, dealt with all the inflation, now seeing prices fall below where they were a prior year means they get squeezed at the margin and ultimately leads to layoffs. So when you hear the word deflation start to pop up, it means an economy is slowing, and usually as it slows, it gets worse and worse and worse. And that's a challenge here that we're seeing in China. And one of the big issues here, we look at inflation against gross domestic product. So here we have GDP for China. This is coming out of the Fed database, so we're using the data we have available, and the consumer price index for all items in total for the People's Republic of China, that in red. And I want you to note the period of kind of moderate or trend rising inflation. You see that kind of from 1998 through 2008, inflation was rising. What do we see in China? You saw GDP growth happening. Of course, we can look at periods where inflation came crashing down. Of course, during the global financial crisis, we see GDP growth in China came down and has continued to slow down. And now we're looking at inflation, potentially rolling into deflation there. And that's saying that economic growth for, again, the second largest economy is headed down. And as you get into deflation, you start to see layoffs build, which leads to less consumption, which leads to more layoffs, less consumption, and you start to see the wheels spinning over and over again. And from a policy standpoint, this is not what central bankers want. This is not what governments want. So with the fact that we're hearing from China, well, maybe we'll have a little bit of stimulus here, is because they're not convicted that this is actually getting worse, but their own data is telling us that there's problems in the global economy. The data intensified calls for more stimulus for the Chinese economy, with attention now shifting to a meeting later this month of the Communist Party Politburo, which will decide economic policies for the rest of the year. Beijing has hinted, though, that stimulus measures this year will be likely limited in scale, reflecting its relatively modest growth target of around 5% for the year. And that's actually extremely modest for China. Perhaps, again, that they don't believe that their economy is indeed slowing. But one of the issues here is we look at, again, they're the biggest exporter. So if you look at external demand coming from other countries, such as the U.S., out of Europe, other countries in Asia, all parts of the world that do their manufacturing and source a lot of their goods out of China. If China is slowing from an external side, and we know it is because we saw the export data last week, well, then either that means they've got to stimulate this thing internally up, which is what our problem is right now, or they just don't believe that the rest of the world's in bad shape, as we know it is. Data for June released by the National Bureau of Statistics showed a slowdown in growth of consumer spending. So now we're starting to see one of the problems here, which has been the main driver of China's economy this year. Retail sales rose 3.1% in June from a year earlier, down from 12.7% in May. So all of a sudden, you see this internal demand. Now remember, what have we been hearing from all of the experts about where growth is going to come from? If you say the manufacturing sector, nope. They've been saying it's going to come out of the services side from consumer spending. We hear that in the US, we hear that in China, we hear that in Europe, everywhere. It's all going to be services now. And what are we seeing? Retail sales in China, big slowdown. So what does that mean? Well, it means that they know the global economy. The consumers know the global economy around them is slowing. They're seeing it in the new order demand. They're seeing their factories slow down. And when you see that and you're working there, wondering if you're going to be keeping your job, you don't go out and spend a lot. And that's what we're seeing happen in the data. It's not an external problem alone. It's also an internal problem. And for countries like China, that means if they start to go down, well, the rest of the world eventually follows them. It's what we expected as a consumption and services-led recovery. If that is sputtering, here you go, then there's no engine left for the recovery. That is it. There's nothing else. And we never want to read too much into 1 month's data. But if the June data on consumption is representative, then that's not a good sign. And so there's the issue. Because the manufacturing sector around the world is so weak that everyone's pinned hopes on the services side, out on the consumer. If you don't have it, where else do you go? Well, a little bit of stimulus out of China isn't going to do anything. Investment by China's vast property sector also worsened in June from the previous month, a sign of ongoing pain in the housing market. If property is the key to resolving the various current problems, the central bank needs to put a floor to the credit crisis among developers to help them survive. And so here you see again, more problems because consumers don't want to spend. They're looking at the economy. They get a better picture of it than we do here because, again, they see this external demand dropping in a big way. They're not incentivized to go out and spend money. They're certainly not incentivized to go out and buy property. And what we know about China's property market is it's a functional Ponzi scheme where people buy property before it's ever built, before they even break ground on it, and they pay for it up front. And of course, if these developers aren't bringing in new money to finish old projects because we know they don't have the money, well, the next thing you know, they start to crumble, takes the banking system down, and next thing you know, the rest of the world follows suit. Property investment fell by 7.9% in the first half compared with a 7.2% decline in the first 5 months. Look at this. New construction starts dropped 24.3% in the first 6 months compared with a 22.6% fall from January to May. So again, we look at the market here of what's going on in China. This is why, again, we're in Beijing right now for the show because we're seeing this slowdown. And if they're slowing down, everyone else is. And that's not the whole story of the problems in China. In fact, probably even more critical than the actual GDP print, China's youth unemployment rate rose to another new record high of 21.3% in June. So not only do you have a problem of demand, you look at internally, you have a lot of youth unemployment. And in a country like China, that's the last thing you need is a lot of young people out of work. It's going to force them to do something. Now, what it means, what they're going to do, we don't know. But for whatever reason, at the moment, the government believes somehow they're not going to need to do much. Maybe it's fear of inflation. I'm not sure at this point because we get very little data from the government there on what their views are, at least what their honest views are. So we'll have to assume they believe inflation is still the problem, but what they're about to find out is we're going to see a lot of deflation. But one thing that shouldn't be deflating is your trading account. Let's get an update on our CTA-Timer Pro. We showed you this from our soybean SOYB trade. This is exactly the day the system said you should probably take a position because we looked at the machine positioning. It was maximum short. It was going down. We told subscribers, look for reversal, wait for reversal, put this on your hot list. If you saw the report that morning, you put a position, buy it open, threw a stop loss underneath there, and now your trade's way up here. This was bought below, would have been a signal below 25 a share, now over 28. What a huge opportunity. That is more than an 8% return. Here you can see it on June 8th. It was max short, and we told subscribers in the notes, hey, if you're not, you got to put this thing on your watch list. It's going to reverse, and it's going to happen, and you want to be chasing it higher. Look at this on the 9th, a reverse position. All subscribers had the report before market open, and if they took that trade, they see just how easy it is to use the report. We show people every week, here's the ones that are down a bunch, put them on your hot list, look for a reversal, take a trade, and you can do that too. It's just $30 a month. Link in the description below with a 30-day money-back guarantee. But now the deflation risk for China is real, and when you start to see one economy deflate, well, you can guess what's coming to the rest, as concerns about deflation mounted last week after China reported no growth in consumer prices in June and a 5.4% contraction in producer prices. Monday, of course, we got the GDP data out of there saying it slowed down as well. So we look at the producer prices, which is important because China's producer prices transmit directly into U.S. consumer prices. Think about it. The last time you bought something and it said made in China, well, if the price to make that product is dropping, well, that means the price for us is going down too, and that means our CPI is headed even lower. Here we can see the producer price index for total for China, that in blue. We see it is now negative. Now this is only available based on the data in the Fed database, so it's actually even lower than this. It's down here somewhere. And this is against the U.S. Consumer Price Index, shown in red, suggesting that where Chinese producer prices go, U.S. consumer prices follow. And you start to look at the Fed and say, wait a minute, they're worried about further inflation. They still are threatening to raise rates, and they may do that at their next policy meeting here at the end of the month. And what we can tell is if China deflates, well, that means we're going to deflate. And that, of course, puts the Fed on the wrong side of this with credit conditions far too tight. Then you start to get into the fact that that next banking crisis that we've warned what's going to happen starts to become a reality at a time the entire world follows China into a recession. But now let's go back because there's still more problems in China, as Chinese banks now face another blow from mortgage refinancing push. Chinese banks' profits may take a hit. Not that we're too worried about that, but get what's really going on here as policymakers urge lenders to lower the refinancing costs on $5.4 trillion of home loans, adding to further pressure on the sector to help revive the nation's flagging economy. So look at this. The government's saying, look, maybe we need to actually get the banks to refi people's mortgage down, because why would they want to do it? Free up some cash flow. And if people free up some monthly cash flow, what is the government hoping? You got it. They go spend it unless they don't. And here we can see China's home prices resume decline after 5 months stabilization. Look, there's nothing that makes people want to buy a home more than seeing deflation, because of course all that means is, hey, if you're going to buy today, maybe wait a few months or more and the prices will be cheaper. Here you can see new home prices in 70 cities, excluding state subsidized housing, fell just a mere 0.06% last month from May, when they climbed 0.1%. Of course, prices declined 0.44% in the secondary market. The issue isn't how small the deflation here, the price decline is. The fact that it's continuing to decline is an issue, and that means people are less likely to buy things if they believe prices in the future are falling. And I do not believe that giving people cheaper interest rates on their mortgages so they can refi them and creating some cash flow will lead to an internal stimulus for the country. I believe people there will turn around and save it. Renewed concerns about the property sector have increased pressure in China's credit market. Declines in high-yield dollar bonds accelerated this month amid debt worries involving major builders. Of course, that comes back to what we talked about a long time ago when China had the problems with its builders going under. You see the same thing happening again. Prices start to come down, demand vanishes, people don't want to buy, and the Ponzi scheme of China's real estate market implodes. And of course, we know that that isn't a good sign at all. But are there any indications that external demand, that coming from the U.S., is actually weak as well? Well, we got some of that data today. Here we have the Empire State Manufacturing Survey, and check this out. It noted that business activity held steady in New York State. So what should we be expecting here is if indeed the services sector is pushing the economy up, which is a belief, the demand for services is now going to lead the manufacturing sector up. It's generally almost always the other way around. Where the manufacturing sector goes, the services sector falls with a lag. But what are we seeing right now from the headline here? No change, no improvement. The headline General Business Condition Index fell 6 points to 1.1, but get this, new orders inched up. That's not a big move, and shipments expanded. Delivery times shortened, meaning people are getting their stuff out from the factory to the retailers faster, and inventories continue to decline. Employment levels edged higher in the Empire State, but get this, though the average work week was little changed. So they brought on a few people, but not much change from the employment side. Input and selling price increases continue to moderate. Planned increases in capital spending remain weak, and looking ahead, while firms expect conditions to improve, get this, optimism remained muted. So again, you look at the U.S. manufacturing sector, it's kind of in this lull. They don't want to lay off because they're hoping demand turns around, but you're seeing no big material move up here either, at least not out of the Empire State. Of course, we'll look at the rest of the regional Fed reports as they come out. But now, according to Wall Street Journal, things may be okay, as pay raises are finally beating inflation after 2 years of falling behind. But will it matter? Well, I don't think so. Inflation-adjusted average hourly wages rose 1.2% in June from a year earlier, according to the Labor Department. That marked the second straight month of seasonally adjusted gains after 2 years when workers' historically elevated raises were erased by price increases. If the trend persists, it gives Americans leeway to propel the economy through increased spending, which can help the U.S. skirt a recession. Since estimates earlier this year, economists surveyed by the Wall Street Journal have lowered the probability of a recession that will start in the next 12 months. So here's the hope, but notably they're just focusing on the wage part of it. They're not talking about the hours. We're going to get to the whole total compensation here in a moment. But what I want you to see is the optimism of, hey, look, maybe inflation is cooling off enough here. Maybe the U.S. consumer will be back online and spend, and then, of course, China will be a benefactor of that, and they won't have to do much stimulus. You kind of see the story here, at least from China's perspective. Consumer confidence in June reached its highest level since January 2022, according to the Conference Board. Americans' assessment of current economic conditions and their outlook for the future improved. Of course, that helps because the stock market went up too. Americans are nonetheless anticipating a recession within the next year, according to the survey, and that's likely because they are aware of the Fed's ongoing effort to fight inflation and how that might trigger a broad economic slowdown. So, of course, everyone believing in the Fed here, but for how long? Well, I don't think they're going to believe too much longer. As Federal Reserve Chair Jerome Powell signaled, wage growth is still too strong. He says you need to make less money for the central bank's comfort in its fight for inflation. He said in June that wage gains had eased, but quite gradually. Pay raises allow consumers to purchase more expensive goods and services, which in turn supports elevated inflation. He says it's great to see wage increases, particularly for people up the lower end of the income spectrum, but we want that as part of the process of getting inflation back down to 2%, which benefits everyone. And all of this is excited about because people forgot to add in the average weekly hours, which we did, and now we show total compensation in blue is slightly above the consumer price index, but it's been too little too late. And remember, total compensation is fairly noisy here, so there are brief periods, even in a downturn, where it can actually get above inflation for a little bit, but it's little too late because, of course, what we know is all of those Fed rate hikes do transmit into higher credit card payments as the interest rate on that goes up. And then starting in October, the student loan payments are back, and that's going to zap a lot of spending power from the U.S. consumer. Perhaps the China will figure that out, and we'll follow them right down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.